wabarakatuh. I'm Halal, representing Financial Alliance Islamic Wealth Advisory. Welcome to Halal Investing and You. Alhamdulillah, we praise and thank Allah for the blessings of time and the opportunity to be here today, despite the not so good weather. And I really thank and appreciate all for having made the effort to come today. My apologies. Okay, ladies and gentlemen, today's seminar is brought to you by Financial Alliance Islamic Wealth Advisory, also known as FIWA. Now, some of you might have heard of FIWA, while others might not. So, let me just tell you a little story. Harun, is everything okay? Thanks. Alright. I believe some of you here watched Hang Tuah before, or Piramli films. Okay. Okay, my apologies, some technical difficulties. Okay, let's just give me a minute to settle this. Okay, are we good to go? Thank you. Right, as I was saying, let me tell you a little story. If the strength of Hang Tuah lies in the letter P, the strength of FIWA lies in the letter I. Because if you were to spell FIWA, if you were to replace the letter I in FIWA with the letter B, it would read FIWA. But we are FIWA. So as a one-stop, as FIWA, our strength lies in the letter I, which refers to Islamic Wealth Advisory. Because as a one-stop financial solution, that is what we pride on in FIWA. And FIWA is a division under Financial Alliance, a leading and award-winning independent financial advisory in Singapore. How can we have that slide? The next slide. Okay. As I mentioned earlier, we are a one-stop financial solution for the Muslims. Why? As a one-stop financial solution, the services that we offer range from personal protection to investment and estate planning. In other words, A to Z of wealth management for the Muslims. Now, I believe each and every one of you would have received this brochure in the handout given. So, if you have any inquiries, feel free to contact us or approach any of our consultants at our booth. Now, moving on to today's agenda. Our first speaker for today is not a stranger in our community. You would have seen him on CNBC, Channel News Asia, and occasionally on Surya, where he would share his views on the economy and market outlook. Now, Mr. Sani Hamid was formerly a senior economist with BNP Paribas and a sovereign analyst with Standard & Poor's. He is currently the head of FIWA as well as a director of wealth management for economy and market strategy. To present to this topic of creating a 100% Shariah compliant investment portfolio, I welcome Mr. Sani Hamid, please.
Assalamualaikum warahmatullahi wabarakatuh. Okay. Today my topic is about creating a 100% Shariah compliant portfolio. Okay. As usual, there's this very important disclaimer here, which means that if I say something and it comes true, please tell my boss. If it's wrong, you can't sue me. Okay. The agenda today is why invest via a portfolio. Yeah, we're talking about portfolios, we're not talking about individual stocks and shares. The Shariah instruments that we need to create a portfolio, do we have them? No use talking about portfolio, but the question is, do we have the necessary instruments for a particular portfolio? And lastly, if we do, what is this complete investment portfolio that we are talking about? Okay? Why invest via a portfolio? You know, the most common way of investing, and this is my belief, I don't think there's been a study or anything, is that a lot of investors invest via the Singapore Stock Exchange. And just for my knowledge, everybody present in the auditorium today, how many of you invest in the stock market? Maybe you buy shares through a broker or you even go online and buy straight? Show of hands. Stock markets. The rest of you keep your money under the pillow. Okay, but anyway, this is more or less because we have friends who do it, we have relatives who do it, we often hear people telling us of market tips and so on and so forth. So this is the most common way of investing. But there are some drawbacks. When you invest in the stock market directly, there are some drawbacks, and I'll highlight some of these drawbacks here. The first one is concentration risk. What is concentration risk? Concentration risk means that you are invested in a very small pool of shares, or even just one single share. Yeah? So here, for example, in a single stock, or if you have a few $1,000 or whatever investable assets that you have, money that you have, it's invested in 4 or 5 stocks. Yeah? So that's a concentration risk. Concentration risk is best understood, for example, during the crisis, when on a Friday night, people holding Lehman Brothers assets or Lehman Brothers shares went home, only to come back on a Monday and found out that they no longer exist. So that's a very high risk kind of a situation because you're concentrated on 1 or 2 stocks. Yeah? Likewise, even if you have 5 stocks, when one of them goes down the drain, you lose 20% of whatever money that you have. Yeah? So that's concentration risk. The temptation to trade. For those of you who trade the Singapore Stock Exchange or you buy shares, you will realize that because you own 1 or 2 shares or 3 or 4 shares, you tend to look at it very often. You bangun pagi, you go and check what's the market in the Dow Jones in the afternoon, or everything on the MRT, or during lunchtime, you're going to see what your shares prices are, so on and so forth. Yeah? So when you hold very few stocks and shares, you tend to be very focused onto it. Yeah? It's like you live the whole day for it. You even know where was the low, what was last closing, so on and so forth. You tend to get very emotional and very tied to a particular share if you have very few. So you have the tendency every time to trade. Come down here, you buy, go up here, you sell, and so on and so forth. And limited opportunities. What if today I told you that everybody believes that Brazil, for example, this is an example, that Brazil is going to do very well. It's got Olympics coming, World Cup coming, it's fallen about 30-40%, it's very cheap. If I told you today you need to buy Brazil, can you do it? Can you call up your broker and say, I want to buy Brazil? Give me a Brazilian share. Your broker will say, here's the number for a broker in Sao Paulo or Brasilia in Brazil, call that person up, and you can do. So you start calling the person in Brazil, fella talks Spanish to you, and you go and speak Malay to him, so on and so forth, So it's virtually impossible if you are doing it on a share basis, okay, to take advantage of opportunities elsewhere. Very, very difficult, and I'll show you later how you can do it, but as an individual investor buying through shares itself, very difficult. And high risk. You're buying into equities. Yeah? You ought to know by now that equities is something which is of a high risk. It's something which is volatile. It's something which is not the same as we will talk about later, bonds, fixed income, sukuks and such. It is a different category by itself. Yeah? So these are the things that actually you have to face, the challenges you have to face if you invest, typically the way you invest currently, which is buying the share, going to the stock market, so on and so forth. And not only that, the way you invest and the way you manage your portfolio is also not typically the correct way. So typically a person who invests in shares, for example, as the market starts to fall, come to a point that you cannot tahan really, you think the pain is really too much. What you do is you take your money out, you put it in the bank and you say, oh, I've seen my 100% of my pension fund go down to about 60%, no, I cannot take any more, I'm going to take it out, I'm going to put it one side. Okay? So you think you've done the best thing in the world by saving the other 60%, only to find out that it starts to move up again. Okay? And it starts to move up again, come to a point where you say to yourself, it's moving up. I'm scared. I'm scared I'll miss the rally. So you start to reinvest that again. So you take half of your money from the deposits, reinvest it back again, and then suddenly the market starts to move higher and higher and higher, and you say to yourself, hey look, this thing, I'm missing this boat, I've only got my money invested, so I need to put in the other half. So you put in the other half, and lo and behold, you normally put in 100% equities at where? Near the top of the market. That's typically how people tend to invest their portfolio. And the same thing, market falls, you push everything back to your deposits, or you take your money out. Market starts to rise, you then put a bit more to equities, and then after that, a lot more at the wrong time. Yeah? Because why? Because basically you're managing your portfolio based on emotions, how you feel. You're not managing a portfolio based on a portfolio. You're managing a portfolio based on how you feel. Yeah? So that's the main thing. Portfolio theory, yeah, in very basic terms, and those of you who are, I see some young faces, undergraduates, who probably take finance as part of their subject, you know that portfolio theory actually basically talks about things, correlation, stocks and bonds, negative correlation. It talks about having maximum returns with the most minimal risk, something called efficient frontier. Most of you won't understand this, but don't worry, I'm not going to go into the technical aspect of it. But it's just good to know that such thing in the academic world, academic literature, it talks about portfolio and how one should manage the portfolio. I'm trying to break it down now to the level of the man on the street, so that you understand to an extent what it's all about. The most important thing is that investors fail to realize they should invest based on their risk profile, not on the way you feel, not on how much money you have, and not on what other people tell you to buy. You should be investing on your risk profile, based on your risk profile. So let's see what we're talking about when we talk about risk profile. Okay. Equities are high risk and bonds are lower risk. Okay. I won't go into details and the technical aspect of it, but basically, I think it's just good to know that basically equities have higher risk than bonds. Okay. The different combination will then help you set a portfolio based on your risk profile. Example, bear with me. If you are a person who can take a lot of risk, therefore your portfolio should be made up 100% of equity. If you are a person who can't take risk, then in theory your portfolio should be made up 100% of bonds. And if you are a person who lies in between, then naturally speaking, your portfolio should be made up 50% of equities, 50% of bonds. So you actually control your risk by changing the allocation of equity and bonds. By changing the allocation 60-40, 80-20, 70-30, 10-90, you are controlling the risk and you are making the risk, or you're making the portfolio suit you. Okay? This is very important because time and time again, and I go back to 2008 when we went on a roadshow across the country, yeah, to north, south, east, west, Woodlands, Tampines. We were talking about the crisis. The crisis was very bad. I had time and time again pakcik, aunties putting up their hands, Sani, I've invested in this particular share. I still remember Costco. I think this lady was telling me, this pakcik was telling me, invested in Costco at 5 Sing dollars and now it was 60 cents. Yeah. And I said, pakcik, how old are you? I'm retired, I'm 60 years old. I said, pakcik, what are you doing investing in this kind of high volatile, risky shares? Oh, kawan I suruh masuk. You know, my friend said it's gave me a very good tip. Yeah? So again, that's emotional investment. That's investing based on what your friends have. You should be investing based on your situation, your risk profile. So the question is, what kind of risk appetite do you have? Yeah? Here, I'm not talking about whether you should eat a crocodile or whatever, the high risk, or snake and stuff. Appetite here doesn't mean how your tummy, but actually means how much risk can you take. Normally when you see a financial advisor, and I think a lot of you have financial advisors, and when you invest, they will ask you to go through a list of questionnaires. Yeah? That list of questionnaires it is not foolproof, it's not 100% accurate, but it will give you a good idea of what type of risk you can take on. For example, I've just taken some of the questions from our own questionnaire, and I've done a little bit of a risk profile questionnaire for you. Let's do it together. If your investment portfolio suffers a 25% loss, you've invested 100,000, now it's 75,000. How easily can you replace the investment with a future source of income? Do you get big bonuses at the end of the year? Or really now you're struggling and you lose 25% so that you don't have any bonus? That kind of thing. So basically, let's for example assume that basically you're just struggling to survive, you've lost 25%, you don't get year-end bonuses, so therefore you will think it will be quite impossible for me to replace such a loss. Okay? You take that one. Second question, which statement best describes your investment preference? Do you emphasize quick capital appreciation? Do you emphasize steady capital appreciation, or all the way down, do you want capital preservation? I want to preserve my capital. I don't want to lose a lot of money. I can't afford to. I don't have much time left. No, I'm near my retirement. I need the money. Are you that type of person? Okay? If you are, then you take. And meanwhile, for those of you who are looking at this, you can even mentally look at the questions and mentally choose the answers and take down yourself. Yeah, because later we'll kind of tell you, I'll kind of tell you what kind of risk profile you have. Third, how do you feel about ups and downs in the financial market? How would short-term movements affect you emotionally? It will not affect me. I'll go up, go down, I can still sleep, I can still eat, I can still walk straight. Some people, it will affect me drastically. Your stock dropped 5%, at work you stare at a computer, but really you don't know what you're staring at. You're that type of person. So if you're that type of person, it will be a 5. And then you go to, so over a 3-month period, if you lost 30%, what would you do? Would you be gung-ho enough to say, wow, cheaper by 30%, go in some more? Are you that type of person? Or you say that, no, cannot take it really, I must sell everything, otherwise I'll lose the other 70%. Which type are you? So again, you choose. Okay? So that, for example, this is my risk profile. So I choose 5, 5, 5, 5. So the absolute score is 20. This is just an example. Normally we have about 10 or 15 questions. So you then see, someone who chooses 5, 5, 5, 5, he goes all the way to the extreme. He is a really ultra-conservative kind of investor. Someone who has maybe chooses 1, 1, 1, 1, he is sorry for the thing, but aggressive investor. So basically mentally now you can just look at the question and you can roughly gauge what type of investor you are. Not foolproof again, but it gives you a good idea. Okay? This is important because if you find out that you're conservative, you should not be 100% equities. Remember I telling you just now? If you find yourself, and the other way around, if you find yourself aggressive, you should not be 100% bonds. You can take risks, but you're not taking on risk, which is also a wrong. Yeah? It's a no-no also. Okay? Not only cannot take risk is wrong, can take risk, never take risk is also wrong. Okay? Then you may ask me, Sani, but why equities and what? Can't we just, why these two things? Yeah? Again, in modern portfolio theory, equity and bonds are supposed to be negatively correlated. I won't go into details again, but it works well together to give you maximum returns and minimal risk. But for the layman, this answer is this. Equities, higher risk, look at the volatility. You can go up from 100 make 100%, go to 200, can lose back 100%, and go back up again. Okay? So you need to have a little bit of a risk attitude to be able to take on risk to survive this kind of shocks. Bond, slow, steady. Oh, lose money? No, can lose money. Then after that, come up again, slow, steady. So for the past 10 years, bonds have provided 2.5% per annum, whereby equities on average have provided about 5% per annum. Not to say every year they give you 5%, but on average. So on average, we have about 50% here, 5 times 10, and 25% here, 2.5 times 10. So equities over 10 years have given you 25% more than the bond market. Rightly so, why? Higher risk, higher return. Lower risk, lower return. Okay? So rightly so. So basically, back again, if you are aggressive, you can take this. Zoom, zoom, zoom. Can still sleep at night, no problem, hand won't shake, you're fine. But if you are a conservative portfolio, you cannot take this. You hold your coffee mug, also the coffee mug never stops shaking. Okay? But you are able to take this, right? It's not volatile. Yes, there are some periods that are volatile, but again, this is nothing compared to this. So you see why people who are conservative should be focusing on here, people who are aggressive should be focusing on here, and in between you play around with 50-50, 50-60-40, 30-70, that kind of thing. That's how you should model your portfolio. Okay, one more time, not on how you feel, not on how much money you have, or not what people say. It's your risk. Your risk has to be reflected in the portfolio. Today, we are lucky because today we have the ability to replace bonds with sukuk, which is the Islamic version of a bond, equities with the Islamic version of a compliant equities. So today we are able to model a portfolio for yourself, Muslims in Singapore, based on Shariah compliant equities, based on Shariah compliant sukuks. So everything is Shariah compliant. You are able to do that. Okay? So I wanted to get over this first part here and not go straight into what are the instruments, because I need you to understand that everybody should be modeling their portfolios based on your risk profile. Okay? You got that straight, huh? You see, the problem prior to 1997, okay? Before 1997, we had a problem. And the problem was there wasn't any, if I remember correctly, Shariah compliant funds. Even back then, I'm not sure, maybe I'll ask Ustaz whether Malaysia had any funds before that. Maybe very few. But because Islamic finance hadn't taken off then, so there were very few funds. So if you were back then an investor and you wanted to invest from a Shariah compliant perspective, you could not. Basically, full stop, period. How will it? Because no funds. Okay? So basically, and that's why our gentleman here is scratching his head, you as a high-risk investor would just have to buy conventional equities. You as a low-risk investor would probably have to buy 80% bonds or 100% bonds in a mixture, so on and so forth. But all will be non-halal instruments. Okay? Back. This problem, was solved a little bit between 1997 to 2008. Because between 1997 and 2008, there were a lot of equity funds that were being released. I think HSBC came out, NUC came out, DWS came out, so on and so forth. The only problem with the equity funds back then was most of them were 100% equities. There were very few. I just remember one, Amanah one from NUC, but they were just, everything was more or less 100% equity. And that's why we had the problem of mati-mati, semua nampak, they see the halal investment unit trust, what they do is they take their money out from the fixed deposit, they put it in the halal unit trust, thinking that they've done very well, religiously correct, because you're taking money from a conventional fixed deposit, and you're putting money in a Shariah compliant unit trust, but from the risk perspective, wrong. You're taking money from something which is virtually risk-free to an extent, because it's in a bank, and you're putting something into 100% equity, high risk. You saw the volatility just now. So when they start losing money, they start saying, Takafo no good. Put money in the bank, it's okay. Put money here, then suddenly I lose money. So that kind of misconceptions start to come out. Okay? So it's not the problem of the instrument, it was a problem of moving the risk profile or mismatch of risk profile. Okay? So that was the problem. So we had back then, because of the lack of low risk Islamic products, all were high risk, everybody invested in high risk. Your high risk guy invested in high risk Shariah compliant products. Your low risk guy also invested in high risk Shariah compliant products. That was the mismatch we had between 1997 and 2008. Okay? There was a slight improvement, or one big step you could say, in 2008 to between 2012. And this was because of the introduction of Sabana REIT and Maybank CIMB. Sabana REIT is a share. Okay? It is a share, but if you ask me to compare with other shares, I think it's considered to be slightly lower risk to a large extent. It's not leveraged, it's nice, it's like a blue chip, because it gives high dividend distribution payout and such. Okay? So slightly lower risk than all the other shares. And then we had Maybank and CIMB, very good of them, came up with the Islamic version of fixed deposits. You could 3 months, you could 6 months, you could 12 months, finally. Okay? So, what investors did, and what we advocate to investors back then between 2000 and 2010 was, we do not have a low-risk Islamic version of a bond, sukuk. So, temporarily put in all these things to substitute. It's not ideal. Ideal is you have a sukuk, but what to do? Don't have. So, temporarily use that as a substitute. So, you have equities versus Islamic deposits. You had that 100% equities for high risk, for low risk, the majority were Islamic deposits. Not ideal, but the religious perspective is still give you 100% Sharia compliance. This was Sharia compliance, this was Sharia compliance, this is Sharia compliance. So for a person who's looking for 100%, could you do 100% Sharia compliance portfolio? Yes. Was it ideal in the sense of modern portfolio theory? No. Because one should be a sukuk or a bond, the other one should be equity. We didn't have that. This particular problem was solved recently because a retail sukuk fund was launched. Everybody knows Franklin Templeton came up with a retail sukuk fund. We were very happy because finally we could replace the deposits and so on with a retail sukuk fund, thus creating for once a real true blue portfolio based on portfolio theory, bonds, equity, but Islamic or Sharia compliant. So today, if you are high risk, you got the Sharia compliant equities, and I'll tell you later how you can get this. If you are low risk, you even have sukuk now. And you can put a little bit of equities and a little bit of REITs and so on and so forth. So still 100% Sharia compliant. So from the religious perspective, you have done your duty because it's 100% Sharia. From the perspective of any finance textbook, this is valid things. These are valid because it follows modern portfolio theory, which has equity share bonds. Okay? So you're not being short-changed in a sense, inverted commas. Okay. So now we've spoken about the ability to create a Sharia compliant portfolio 100%. The question is, what goes inside? What are these things that goes inside the various allocations, the equity allocation, the bond allocation and such? Let's have a look. Templeton recently launched not only the sukuk, and we'll get to the sukuk later, but something called Shariah Global Equity Fund. These are unit trusts. For those of you who are not familiar with unit trusts, basically it's like this. You give the fund manager $100. The fund manager will take your $100 and your fund manager will allocate it to 37% US, 12% UK, 9% France, so on and so forth. This particular column will change because you are paying the fund manager, not for free, to make the decision. We think the US is going to do well, we think that France. So he will make the decision for you. You are giving him the trust, that's why I call you trust, to manage the money, to try and make money for you, and this is his recommendation. Of all here, most of them are in healthcare. One of the easiest things to be Shariah compliant, energy, industry, information technology. So, as you can see, financial, zero. Especially in the Western world, financial, zero. Very hard to find an Islamic financial bank or Islamic bank in the Western world. So basically, naturally, it's zero. Among the top holdings, Pfizer, Chevron, Vodafone, I think I own part of this company, Sanofi, SANI here, PHP Billiton, Novartis, so on and so forth. Okay. So this invests globally, US, Europe, and a little bit of Asia, so on and so forth. Okay, so it gives you a very global kind of reach. The other fund that was launched, and before that, let me just show you. They invest about 80 shares. Okay, so this one particular board manager invests in 80 shares. Again, as an individual, you will never be able to do this. Can you imagine you have $1,000? How are you going to go buy 80 shares? You can't. You're not going to break down the $1,000 with 10 Sing dollars and go down to buy this share. You won't be able to. But you can do it through a fund. Okay? You give the fund manager $1,000, that's the minimum amount. He goes and invests accordingly in all of this. Okay? So there are 80 shares here. The second one that they launched was Shariah Asian Growth Fund. Majority in China, South Korea, Thailand, Indonesia, Hong Kong, so on and so forth. The sectors, energy, consumer discretionary, so on. You do find a bit of financial. This is quite unique because in Asia you can find Islamic financial institutions. Yeah, NB, Islamic, whatever. Yeah, which was never the case before. Okay? But now increasingly there are Islamic institutions in Malaysia, in the Middle East and so on, where they can actually invest in. And these are some of the names of the shares that they invest in. I took this up because I think some of you may recognize the name. Mark Mobius, if you've seen CNBC or you know the Botak guy who anybody knows Mark Mobius? He's a very famous guy. So he's actually running this fund. Yeah? If you're in the investment world, you probably know who Mark Mobius is. So he's actually running the Shariah Asian Growth Fund. Okay? Okay, this one. This has been, and this is not another statement, this has been God sent. Yeah? So, in my true belief, this one, we have been missing this for a long time, and finally we have it. This is a global sukuk fund. This is the one that you replace your conventional bonds with. Sukuk, in a very loose terms, are fixed income or the version, the bond version, the Islamic bond version. Okay? So United Arab Emirates has a whole bunch of it, Malaysia, so on and so forth. Okay? It's corporate bonds. Just some of the details, who's about 38, so on and so forth. But this one allows you now to create a portfolio which I was talking about. Again, the volatility is not as much as equity, it's much less. Another one that you can put in your portfolio, DWS, no precious metals. These are miners. Okay, this is not gold itself, but these are the people who will mine for the gold. The miners. Okay. You see this big red tick here because I like it very much. Okay. I think miners today are one of the most undervalued companies that you can find among the equity markets. Okay. I think one very important thing when you talk about gold price, I think a lot of people here are quite interested in gold prices. Okay. Gold price today is about 1,350 to the US dollar, around that. Do you know that every miner in the world today, if you look at their books and everything, the cost of digging gold out from the ground and then processing it, cleaning it, and bringing it to the market to sell, the cost range from $900 US to $1,300 US. There's a cost to it, right? Cost of digging, washing, security, putting it into the market. The more efficient miners cost 900, the less efficient miners 1,003. Where's gold price now? 1,350. Imagine for 1 second that you are a miner, and I know a lot of you got a smile on your face, you're very happy that you're a miner. If gold prices falls below 1,300, 1,200, 1,900, and it costs you 900, 1,000 to dig it up, what will you do? Let's say gold price of gold now is below 1,900. You as a miner, it costs you 1,300 to dig the gold. What will you do? You will stop mining. Why would you do such a stupid thing? They wash, security, put it on the market 1,300, but I can only sell 1,200. I can only sell 900. The cost of getting it out is 1,300, and you're selling it at 900. So what do? You stop mining. And there are already a lot of companies you can stop mining at these levels. And when you stop mining, supply of gold shrinks. And when supply of gold shrinks, even with the same demand, prices go up. Okay? So natural demand and supply. Do a bit of reading on it, very, very interesting. But that's part of our reason for our call that miners are actually quite a good thing to have at this particular point. Okay? Moving on. Savannah REIT. I've spoken about this many, many times. Last year's REIT conference, so on and so forth. Okay? A lot of properties. It recently annualized yield in second quarter. It's giving out about distribution 8%, 7%, 9% at one time and stuff. I know Savannah REIT has fallen a bit from about 140 to about 110 now. Some of you are panicking. Yeah. But don't worry. Unless your view on this is very bad. Unless you think this goes down to 2%, you have nothing to worry about. The logic being, let's say this is maintained for the next 10 years. If Savannah REIT gives you 8% return over the next 10 years, how much is that? 8 times 10? 80%. So they give you back 80%. If your stock price drops by 80%, which is, cannot think, 80%, at the end of it, how much are you getting back? Do you lose money? You lose money? No. Stock price drop 80%, dividend get 80%, I'm square one. So what is the chances of the stock price dropping 80%? Some of you say no way, right? If no way means that you're guaranteed to make money. Because from the dividend itself is very high. So if you take a long, what I'm trying to say is, if you don't understand a single word I'm just saying, if you take a longer term view, I think that cannot be guaranteed. I think you'll do fine. Okay? Okay, we move to the last segment. A complete asset allocation for Muslim investors. So we know that as a Muslim investor, you need to do your risk profiling. You need to find out what is the allocation that suits you based on the risk profile. We know now what are the available instruments that can be put in to your particular portfolio. So therefore, what is this? Please forgive me for the running of this one. Okay. So basically, if you are a low risk investor, this is taken as an example. Please don't take this as your ideal portfolio. You need to sit down with your consultant or whoever you engage to work it out. This is just an example. If you are a low-risk investor, then we would recommend up to even 80% in the global sukuk. Very wide diversification. Then Savannah REIT for global precious metal for Asia growth A and then global. So it's like that. That's how you form your portfolio. Okay? That's how you protect yourself if you are a low-risk investor. You have the most of your money in a bond fund or a sukuk fund. So this is the balance, and I can't really see, but I'll go very quickly to the aggressive one. So if you're an aggressive portfolio, you can take a lot of risk. Therefore, most of your stuff, 100%, are all equities. Global equities, 15%. Asian equities, 45%. Gold miners, 15%. REITs, 15%. And Singapore Shariah, and I'll talk about this later. Stocks. You can put stocks in. Shariah compliant stocks, you put stocks in. So it's 400% equities. You would have noticed here that the different allocation, 100%, it captures the risk appetite. You're aggressive, you should be in this. not 100% bonds. Cannot be, Second, it provides diversification. See, I have some in global, some in Asia, some in commodities, some in REIT, some in stocks. So it provides diversification, which is very good. You should be diversified as an investor. And it enables views to be represented. What do I mean by this? Look, I have 45% in Asia. Why, Sani, do you have 45 in Asia and the rest all a little bit here, a little bit here? Because I believe Asia, I have my reasons to believe Asia will do well for the next 12 to 24 months. Okay? After the tapering of the quantitative easing, the general view, my general view is all the markets that did very well before the quantitative easing ends, US, Asian bond markets, all will start to unravel, and those markets which never did well over the past 12 months, those will start to go up. And Asia hasn't been doing well over the past 12 months. So I think those markets will start to go up. Therefore, recommendation is slightly more heavy on Asia. Okay? Oops. Okay. The portfolios can vary a bit. And I'm just telling you one or two variations here. One of the variations is, if you look at, I mentioned here, Shariah compliant stocks. You may be asking me, Sani, where do I get Shariah compliant stocks? There's only one stock in Singapore, which is Sabana REIT, which is Shariah compliant. Where are the others? Okay. Basically today, investors in Singapore have the opportunity to subscribe to a software by Ideal Ratings, and you can do your own screening. They provide screening. Means to say, you can screen every single stock on the stock exchange, your SPH or whatever. You name any stock, you give me any stock, you throw to me any stock, I can check for you whether it's Shariah compliant based on a rule book. What are rule books? Rule books are Middle East rule book, IOP rule book, FTSE rule book. These are the way they screen the stocks. You just need to know these are the ways. We can do it today. So today, anybody who buys any single stock on the Singapore Stock Exchange can determine whether the stock is Shariah compliant or not. Okay? But for sure, don't think it's not Shariah compliant, okay? That one don't have to ask me, that don't have to throw to me. I throw back at you. Okay? So again, this is a very good, I'm not trying to promote the software or anything, but again, it's, Ideal Rating normally provides their data to fund managers. This is the first time they provided it to the retail investor in the world. So Singapore investors have this privilege of using this to screen the stocks on the Singapore Stock Exchange. They even tell you how much you need to purify. As a Muslim, you get dividends. Part of that dividends has to be purified. They even tell you how much you need to purify. So very complete. You ought to be very proud of it. And it's not very expensive actually to subscribe to this. And then I think the question will also go to finally, okay, fine, Sani, after half an hour, I believe what you say, so how do I start off? Some people have this misconception that it takes a lot of money to buy, to get invested. If you're buying SPH one lot, yes. How much is SPH now? Anybody? One buys SPH, is it? Is it $7 or $4? Okay, $4. So SPH is $4, one lot is $4,000. So you need at least $4,000 to buy into this one lot of SPH. Okay? But fund, you just need $1,000. You can buy into the fund. Better still, I know money, I don't have $1,000. Can I do it every month? Sign a gyro form every month. Yeah, you can. Even less, 100. 100 goes into, let's say for example, 100 goes into the sukuk fund, 100 goes into the sukuk fund, 100 goes into the sukuk fund, 100 only. Yeah? But if you want to create because this is only one fund, if you want to create a perfect, not say perfect, but a complete portfolio with 4 or 5 funds inside, then of course I think you need more. Yeah? Because each fund got 20%, each fund got 30%, each fund got 5%. So you need about 10,000 to create the ideal portfolio from that perspective. Yeah? You need to talk to your financial advisor with respect to your risk profile and see how you can do this particular portfolio mix. Okay? In summary, today Muslims can create 100% Shariah compliant portfolio in Singapore. Anybody who comes to me and says, Sani, darurat lah, still have to buy the conventional one, I tell you cannot. No more. because it's available, I'm telling you. Okay? So there's no such thing as it's not available. It is available today after the introduction of sukuk, that you actually can create a portfolio based on any finance theory or portfolio theory. It is the correct and the perfect portfolio. Okay? Risk profile, make sure your portfolio reflects the risk profile, well diversified against a single stock, and the portfolio can participate in opportunities geographically. US, Europe, Brazil, China, which you will not be able to as a single investor. Okay. I'll end it now, and later if you have any questions, you can ask me.